You see silver moving this high, there's a natural question, is this peak silver? And because of the manipulations and because of these kind of mechanizations, could silver be dramatically retraced? Yes. The other trick is they can do limit orders. Just say you can only buy so much silver and that's it, and that's limit orders. That also tries to keep the silver price from ripping too fast. And the most desperate act they can do is make it a sell-only exchange. You can only sell silver to keep the price down. If there's a market mean reversion, could we see a sell-off in gold? Yes. But a pullback from what price? Gold at 5,000, 6,000, 7,000? The Teslas of the world, the Samsungs of the world, when they saw that manipulation down, very short, didn't last long, when they saw the sale price on silver, they didn't panic, they bought more of it because they need it for industrial uses too. So the game to manipulate the price down on silver, to buy time and to push the price down, failed in December. I can predict what Shanghai or St. Petersburg are going to do on their exchanges. If I were them, I would offer, the COMEX is not a place to store gold, it's a place to manipulate the gold price. And but it's legalized price fixing.
COMEX, they've had like 3 margin hikes, I believe, 2 or 3 margin hikes on silver recently. Silver bounced right back in. And we now see where the CME Group, the world's leading derivatives marketplace, announced it will launch a 100-ounce silver futures contract, and goes on to say these futures contracts will be financially settled. Nowhere does it say physically settled. So I just wanted to get your opinion on this.
Yeah, listen, again, each of these topics, on the COMEX, the LBMA markets, the SPY-MEX of Shanghai, but certainly the COMEX in New York and the London exchange in 25, frankly, starting in November of 24, really going into 25, has seen so many historical and massively significant changes, which most folks won't understand because the COMEX market and futures contracts and swaps are intentionally complex. And I think to try and unpack that, I've written about it for years, I've warned about it for years, it's really come to fruition in 25. To simplify it and then to talk about these margin hikes, the COMEX is not a place to store gold, it's a place to manipulate the gold price. And but it's legalized price fixing.
When a futures exchange launches silver contracts without physical settlement, it quietly tells you more about liquidity stress than innovation. As Matthew Piepenburg has warned, margin hikes and cash-settled contracts often surface when physical delivery becomes inconvenient, not efficient. CME's 100-ounce contract avoids metal delivery precisely as global inventories tighten, which mirrors prior stress points seen in late 2024. Historically, when derivatives expand faster than underlying supply, price signals become distorted rather than clarified. For investors, this matters because paper exposure can dilute real demand signals, masking risk in industrial and monetary metals. These structures benefit intermediaries, not long-term holders seeking true price discovery. Next, Matthew Piepenburg explains why leverage ratios expose the real fault line in gold pricing power.
The COMEX has, for every, it's got a 96% leverage short against the gold price every morning. 4% gold, 96% paper gold. And they get up every morning and a handful of LBMA banks lever paper shorts against the actual price of gold. So that keeps the gold price controlled. It's been doing that since the 70s. Gold was intentionally manipulated downward. There's a lot of reasons for that, mainly because gold is a middle finger to the dollar. So they had to keep it down. That was a deliberate policy. That worked as long as there was enough gold and silver on these exchanges to then lever short. What happened in 2025, we saw it in the silver market and in the gold market, is that the exchanges literally didn't have enough physical gold and silver available to lever. There was a massive exporting of the gold from, normally, you saw, I think it was in October, my whole career, the COMEX saw 1% free float or standing for delivery. The gold just stayed there and kept being levered. In 2025, we saw in the summer 100% standing for delivery. That's extraordinary. That's a huge headline.
A market built on 96% paper only works as long as no one asks for the other 4%. Matthew Piepenburg has consistently highlighted how extreme leverage suppresses gold's signal against fiat credibility. A 96-4 paper-to-physical ratio isn't hedging, It's control, and it worked for decades while delivery demand stayed low. In 2025, that math broke when delivery requests surged to 100%, an unprecedented stress event the headlines barely addressed. Once metal leaves the exchange, leverage loses its anchor and price control weakens fast. For investors, this is a regime shift. Paper pricing power depends entirely on physical compliance. Matthew Piepenburg next connects this delivery breakdown to why silver seized up even faster.
The gold was just leaving the COMEX as fast as it could come in. So the ability to short and manipulate it got weaker. The same thing happened in the silver markets in 2025. They literally seized up. There just wasn't enough silver in London to make delivery. It's supposed to be a cash and carry exchange. They blamed it on the weight of silver, truckers not being available, supplies. No, it was just the counterparties on the COMEX and the LBMA markets wanted their physical gold in their own hands now, because gold and silver are so much more important going forward than they were in the last 50 years because of all the changes we've talked about. So with not enough physical metal, gold or silver, I'm simplifying a lot here, on these exchanges, the game of manipulating the price down gets harder for them to play. So free price discovery gets easier for gold and silver. As they're running out of these actual, in the case of silver, if there's less silver actually available, I think the available global free float available silver for delivery in the world was like 38, it was so minuscule, billion, it was nothing. So there was nothing to manipulate. So what did the silver markets try to do? In December 12th, they raised the margin costs.
When exchanges blame truckers instead of inventories, you know the story is breaking down. Matthew Piepenburg has pointed out that delivery excuses usually surface after control is already lost. London's silver market didn't face a logistics issue. It faced a withdrawal problem as counterparties demanded metal over promises. With global deliverable silver reportedly near 38 billion ounces, manipulation tools lost traction fast. Raising margins on December 12th wasn't risk management. It was a defensive response to shrinking physical float. For investors, this exposes how thin real liquidity is beneath paper pricing. Matthew Piepenburg then explains how margin hikes force selling without fixing the real problem.
And again, I don't want to get too wonky. What that means for people who know a lot about the COMEX and people who know nothing. But what that meant is if you're going to play the silver game on the COMEX overnight at Friday at 2 a.m., they said, oh, we're just going to jack up the price to do that, to play in this game. And a lot of speculators in the COMEX, usually the shadow bankers, the hedge funds, etc., well, they didn't have the money to pay for that margin hike, that buy-in, and the casino. So the system automatically sells them out at price. They just sell them out. So then you get a massive selling of silver when they're forced out because of these margin hikes. When there's a massive sell-off in silver, that pushes the silver price down. That was the intention. What happened to the chagrin of the market manipulators is that a lot of others, the Teslas of the world, the Samsungs of the world, when they saw that manipulation down, very short, didn't last long, when they saw the sale price on silver, they didn't panic. They bought more of it because they need it for industrial uses too. So the game to manipulate the price down on silver, to buy time and to push the price down, failed in December.
Margin hikes don't reduce risk. They simply decide who gets forced out first. Matthew Piepenburg has noted that margin increases act like an eject button for leveraged players, not a cure for supply stress. When COMEX raised margins overnight, weaker hedge funds were liquidated automatically, triggering price drops by design. But industrial buyers like Tesla and Samsung stepped in, revealing real demand beneath paper volatility. That response matters for portfolios because it shows downside pressure was artificial, not fundamental. Forced selling can move prices temporarily, but it can't replace missing metal. Next, Matthew Piepenburg warns what happens when these tactics stop working altogether.
Now they're trying to raise margins again and again. They did that in 1980. They did that in other times. And it was eventually successful. I think the world's very different today because of the demand industrial and monetarily for these metals. Doesn't mean I know everything, but I think that COMEX and LBMA market is facing much bigger headwinds because the demand for those metals is so much higher than their ability to manipulate. There are other tricks they can do besides just increasing the buy-in for the casino, for the poker game. The other trick is they can do limit orders. Just say you can only buy so much silver, and that's it. And that's limit orders. That also tries to keep the silver price from ripping too fast. And the most desperate act they can do is make it a sell-only exchange. You can only sell silver to keep the price down. But again, I think, and again, we're all kind of journeying this together. I think if they go to that nuclear option, then I think the world's just going to say, you know what? I'd rather go to an exchange in St. Petersburg or Shanghai if London and New York are playing these games. It's what I would do. And the question is, will Shanghai and St. Petersburg give fair exchange, fair price discovery on these metals than London or New York?
This isn't market stability. It's control measures escalating as confidence erodes. As Matthew Piepenburg has warned, repeated margin hikes, position limits, and even sell-only rules aren't signs of healthy price discovery. They're signs of institutions losing grip over supply-driven markets. In 1980, these tactics worked because physical demand was weaker. Today, industrial usage and monetary demand collide at the same time, a structural shift the COMEX and LBMA weren't built to handle. If Western exchanges restrict access further, liquidity doesn't vanish. It migrates east where fair pricing becomes a strategic weapon. What Matthew Piepenburg highlights next is why exchange credibility may matter more than metal prices themselves.
These are all things none of us know for certain. What we do know is in 2025, the exchanges in London and New York literally didn't have the available metal to manipulate it like they could for decades prior. That is a major sign that I think, again, whatever the sophistication level is, again, many of your viewers may know the COMEX fluently, and some have no idea. Most don't because they're not supposed to. Like the Fed, like quantitative easing, like derivatives, like swaps, all of this is meant to be so confusing that you don't want to think about it. And I want to make it simple by just saying it was a legalized price manipulation in New York and London by a handful of big banks in bed with the BIS, and they've been doing it for decades. And everyone on the street knows it. It's an insider trade. Peter Umbro wrote a great WikiLeaks thing. He admitted he was one of the guys that did this. That worked as long as they had the gold and silver there, and as long as they were unregulated, that game went on for decades. What we saw in 2025 was a watershed moment on these exchanges. And again, most people don't know what to make of it because up until 8 months ago, no one even knew what the COMEX was. And then it started making headlines. So it's a very important question. I'm simplifying a lot.
The real shock here isn't volatility. It's the sudden absence of physical metal where it was assumed to always exist. As Matthew Piepenburg has noted for years, paper pricing only works as long as physical supply backs it, and 2025 exposed that fault line in London and New York. COMEX leverage ratios historically ran 50-1 or higher, masking how thin real inventories actually were once demand surged. When insiders admit manipulation only worked while metal was plentiful and oversight weak, that's not a theory. It's an admission of systemic fragility. For investors, this reframes price dips as liquidity events, not failures of demand, and raises real questions about counterparty risk. What Matthew Piepenburg highlights next is why this breakdown didn't happen by accident, and why it may not be reversible.
But the COMEX and the LBMA exchange in London is not what it was 5 years ago, 4 decades ago. It's changed dramatically because the demand for the physical metals is so much stronger than the churn and burn price fixing that they'd been doing for years. And they're losing some of their teeth. They're losing some of their fangs. They're losing some of their nails. They don't have the power they used to do. That has massive ramifications. It doesn't mean, like any army that's losing, they're not going to keep fighting. It doesn't mean that manipulations won't continue. And it doesn't mean I can predict what Shanghai or St. Petersburg are going to do on their exchanges. If I were them, I would offer a fair price discovery for gold and silver in the East than in the West and make the market move that way. I don't know if they will. Russia and China have their own interests in trying to control gold and silver as well, as they're trying to stack as much as they can. In the end, he who has the most gold will win this game. And to this point, based on audits and World Gold Council reports, no one really knows who has the most gold, including Russia, including China, including the US. We don't really know. There's no real audit, although that was promised. So there's so many moving parts, Patrick, so many moving parts.
The power shift isn't about who sets prices, it's about who can actually deliver metal when asked. Matthew Piepenburg has pointed out that Western exchanges were designed for paper velocity, not physical settlement, and that imbalance is now colliding with record sovereign and central bank demand. In 2024 alone, central banks reported over 1,000 tons of gold purchases, yet true audits remain opaque across the US, China, and Russia. That uncertainty matters because price discovery migrates toward credibility, not volume. For investors, this signals a long-term rotation away from synthetic exposure toward physical-backed assets and miners with verifiable reserves. Matthew Piepenburg's next warning focuses on how this uncertainty favors accumulation over speculation as transparency erodes.
But I think the takeaway is gold and silver are in much higher demand. The COMEX in London exchanges are losing a lot of their teeth. And the reason that they're losing their teeth is because those metals are in demand, and they're in demand because they're better stores of value than paper money. And that is not a gold bug apology. That's a universally understood fact these days. So we're well past gold versus the Dow. We're well past gold versus Bitcoin. We're well past bubbles and bears and whether it's a bull or bear trend. This is more than a bull trend. This is a structural turning point in our monetary system. I can't emphasize that enough.
You know, the year-to-date prices of last year, 2025, I think gold gained some roughly 70%, silver roughly 150% or so. My question here, do you think we will see more of the same this year? And is this a showing, a crack of this, I'll just call it a monetary regime change that is going on that may ultimately manifest?
Yeah. It's the question du jour. Is this peak gold? Is this peak silver? It's a very important question. The short answer is no, not at all. We're going to see higher gold and higher silver. It's a mug's game to predict the price of that in fiat money. That said, let me be very clear as well. Again, many people fear like, well, look, we've peaked out. It's too late now. I remember having that same conversation when gold hit 2,100, 2,400, 2,800. And I will be very blunt in saying I see gold and silver going much higher. Silver is a lot more volatile than gold. It's a whole different conversation. But keep in mind, this does not mean that I'm price predicting or price targeting for 2026. I see it meaningfully higher.
This isn't about chasing returns. It's about recognizing when the rules of money itself are changing. As Matthew Piepenburg has explained, when gold rises 70% and silver 150% in a single year, the story isn't momentum. It's currency debasement showing through asset prices. History shows similar moves during regime shifts, like the 1970s, when real assets repriced as trust in paper eroded. Volatility in silver doesn't negate the trend. It confirms speculative pressure alongside structural demand. For long-term investors, this argues for position sizing, patience, and avoiding leverage rather than calling a top. Matthew Piepenburg's next insight reframes why too late. Thinking often marks the middle, not the end, of monetary transitions.
I said that years ago when gold was at 1,600. I didn't say it will be at 4,400 in 2025. I just said it will be meaningfully higher. Because I'm not looking at technicals or cup and handle price targets, because you're measuring that in a currency that's always losing value. I look at gold and silver and their compressions and their ratios. But more importantly, I look at gold and silver as anti-fiat direction. So of course, if the fiat money of the world is changing and there is no solution for fiat money, it will need to be monetized to pay these debts that are over 300 trillion globally. So to me, my opinion is that paper money can go nowhere but further south, relative or absolute terms. You can certainly the peso, I'd rather have a dollar in Argentina than a peso. Absolutely. Or I'd rather have a dollar than a Turkish lira. I get that. But in general, all paper money, including the world reserve currency, has nowhere to go secularly but down. And gold, therefore, and silver have nowhere to go secularly but north. Does that not mean we won't have pullbacks or retracements? Absolutely, we can have pullbacks and retracements. We've certainly seen it in prior bull markets, including gold, which ripped from 35 to over 800 between 71 and 1980.
The key insight here isn't the price level. It's the measuring stick being used to judge value. As Matthew Piepenburg emphasizes, projecting targets in a currency that structurally loses purchasing power distorts the analysis from the start. With global debt now exceeding $300 trillion, monetization becomes a policy necessity, not a theory, pushing all fiat currencies lower over time, despite short-term relative winners. History supports this framework. During the 1971 to 1980 period, gold didn't rise because of speculation, but because confidence in paper eroded. For investors, this reframes pullbacks as volatility within a secular revaluation, not a signal the thesis is broken. What Matthew Piepenburg connects next is why retracements don't invalidate anti-fiat positioning. They reinforce it.
People forget that mid-year or midway through that bull market in 1975, gold got its knees capped. It got kneecapped. And that shook a lot of people out. Silver too. When you see silver moving this high, there's a natural question, is this peak silver? And again, and because of the manipulations and because of these kind of mechanizations, could silver be dramatically retraced? Yes. But if you're holding these assets, these monetary metals for the right reason, and you're thinking longer term, especially with gold, and we can talk about silver, but you're going to have a little more courage through the highs and lows. There obviously will be retracements, especially if there's a market mean reversion. This immortal stock market in the US, will it ever mean revert? Will it always be too big to fail and subsidized by the Fed? I don't know. I still believe in mean reversion and Bob Farrell and Charlie McKay and Ben Graham. I think I'm not alone. I think Ray Dalio, Druckenmüller, we all see, we can't time it. We just see a bubble. If there's a market mean reversion, could we see a sell-off in gold? Yes. But a pullback from what price? Gold at 5,000, 6,000, 7,000? I don't know.
The uncomfortable truth is that volatility is not a flaw of bull markets. It's the admission price. Matthew Piepenburg often reminds investors that the 1970s gold bull market included brutal shakeouts precisely designed to exhaust conviction before higher highs emerged. Mean reversion still matters, especially in an equity market supported by liquidity rather than earnings growth. But timing it has broken far more portfolios than patience ever did. If equities revert while debt remains elevated, precious metals may dip, but from far higher baselines than today. Long-term holders aren't betting on smooth charts. They're betting on math and policy. What Matthew Piepenburg underscores next is why fear of pullbacks often peaks right before durability is proven.
If you're trying to wait for a pullback to get into gold, you're going to be playing a dangerous game. I had a very important and necessary debate with someone who saw a retracement earlier in the year when gold was at 2,800. Many people might have thought, well, I'm going to wait. But it didn't retrace 30%. And if it retraced even 30% from today, it'd still be better to have bought it earlier in the year. So I'm saying I do not and cannot time when or how much the retracement will be. I will certainly tell you that gold will have retracements and silver. If you're holding it longer term, I think you should be very careful about trying to time your entrance. Timing an entrance is very hard. If you're holding it for 10 or 15 years, at least, which is what myself and our clients and Egon has been doing for decades when he bought at 300. He's never talked about the price. He's just saving in it. If you're thinking generational wealth, if you're thinking wealth preservation, if you want to stay outside of the banking system and save in an asset that holds its value more than a melting ice cube, yes, it's painful to pay at these higher prices. I think 10, 15 years from now, the prices will be much higher in fiat terms.
The real risk here isn't buying too high. It's never getting positioned at all. As Matthew Piepenburg points out, waiting for textbook pullbacks often fails in secular monetary shifts because price resets happen faster than psychology adjusts. Even a 30% retracement after a major run frequently leaves late buyers worse off than early participants who endured volatility. This isn't a trading vehicle. It's a long-duration hedge against currency erosion and banking system fragility. For investors thinking in decades, not quarters, entry timing matters far less than sustained exposure. Matthew Piepenburg's next point clarifies why generational strategies ignore price chatter and focus on purchasing power instead.
And so I'm not trying to not answer the question. I don't know the price target for 2026. I do think 20 years out like Egon does, and I just would rather own or measure my wealth in something that holds its value more than a paper currency. But I will say, I think 2026 is already showing the same things we saw in 2025. Desperation, higher debt, and therefore more currency debasement. I think QE, which started at the Fed, it was QE that started at the Fed in December, will get exponentially higher. I think the Fed's balance sheet will get exponentially higher. I think the purchasing power of the world reserve currency will get exponentially weaker. And so gold should track that directly by going up and to the right while the dollar goes down and to the left. But again, we don't know in January of 2026 if there is a war. Wars can be very disruptive. It can be very good for gold, but it can be very good for markets. It can be different for yields. There are things we can't predict in the near term. As Hemingway warned, when you're in this much debt, you debase the currency and you go to war. We do see more war drums and rumors of war and talk of war. I cannot predict that.
The bigger signal isn't price targets. It's policy behavior repeating under heavier stress. Matthew Piepenburg has repeatedly warned that rising debt mathematically forces balance sheet expansion, and the renewed growth of QE confirms that constraint is back in play. The Fed's balance sheet already sits near historic highs, and any economic or geopolitical shock in 2026 raises the odds of further monetary dilution. Gold's role here isn't speculation. It's a mirror reflecting policy desperation. Investors should recognize that uncertainty itself is becoming the catalyst. What Matthew Piepenburg flags next is why geopolitical risk accelerates trends already baked into debt-heavy systems.
You can wake up like you did in August of 1971, have an announcement, and the whole world changes on the dollar. You can wake up like 9/11, and the whole world changes because of an event in New York. You can wake up in 2020 and be locked down in your house because of a virus. There are things that can affect headlines and movements in intervening years. But my strong belief, and this is the belief of all of us at Von Greyers and our clients, is we know the longer term direction of gold and silver because we know the shorter term or the longer term direction of fiat money. This is the end of a fiat paper money system.
The lesson history keeps teaching is that regime changes don't announce themselves politely. As Matthew Piepenburg often notes, the biggest monetary shifts arrive overnight. Nixon's 1971 decision, post 9/11 policy pivots, or the 2020 liquidity flood all rewrote financial rules instantly. Short-term shocks vary, but the long-term trajectory of fiat debasement remains consistent across decades. That's why precious metals function less as trades and more as insurance against systemic surprise. For investors, the question isn't timing the event, but whether portfolios are built to survive one.